Hi, in this video we'll pick off where we left off, talking about book tax differences. Okay, so we talked conceptually about temporary differences with timing. There's also some permanent differences between your taxable income and your pre-tax financial income. So here are some items that are recognized for financial reporting purposes, but not for tax purposes. So for example, if you have interest on a state or municipal bond, under US GAAP, that would be income, but the IRS says that it's not taxable, not ever. So it'll be a permanent difference. Also, if you had some expenses you had to incur to obtain tax-exempt income, like paying for a lawyer or someone to figure out how to get out of paying a lot of taxes for your corporation, you would deduct that as part of your expenses on your income statement, right? But the IRS, I think you can probably guess, they do not let you deduct that, And there's some other stuff. If your company is fined from because you violated a law, you don't get to deduct that on your tax return. Okay. There's not too many of these. I don't want you to go memorize all of them, but there's just something to know. There are permanent differences. So anyhow, let's talk about temporary differences. Okay, let's do an example. Temporary differences are going to lead to what we call deferred tax assets, or DTAs, and deferred tax liabilities, or DTLs. And this is very important to understand. This is really the crux of the whole unit here. Let's get into it. Let's say Strider has credit sales of $180,000 in 2014, and it expects that it's going to actually collect the money from these sales as follows: $55,000 the following year, and then $60,000, and then $65,000. So pretty generous credit terms, but whatever. This is the idea. For 2014, Strider Incorporated's pre-tax income is $300K. The tax rate for all years is 30%, and they don't have any deferred taxes at the beginning of this. So we're starting simple example here. Okay, so you have a temporary difference, right? From the perspective of US GAAP financial reporting, you have $180,000 worth of revenue, and then in 2014, from the IRS perspective, you have zero, and for the following years, it reverses. From the IRS perspective, you have taxable income of 55, 60, and then 65. From US GAAP standpoint, zero. All your revenue came in 2014. Okay, so it's a temporary difference. So let's see. The problem may ask you, say, hey, compute taxable income and income taxes payable for the year 2014. So this is IRS perspective, taxable income, and then what is income taxes payable. So look, here's the way I like to do it. You got that chart. I don't know where I can draw it on this PowerPoint. Let's see. You got pre-tax, US GAAP income. It's kind of hard to write with, sorry guys. A little messy. Remember, that's not going to be equal to your taxable income. It is hard to draw with this. All right. Okay, they're very different, but whatever they are, all I do is I'm going to multiply them by the tax rate to arrive at, income taxes payable over here and income tax expense over here. I actually wrote some messy. Let me just go back to that slide to show you real quick. There it is. That's what I'm trying to draw right there. Okay, so you got 4 boxes, and the way this a lot of the questions in this this unit are going to go is that they're going to give you some of the boxes, and they're not going to give you others, and you just got to figure them out. But it's real easy. If they gave me this box, pre-tax financial income, I just need to multiply that box by whatever the tax rate is, 30%, and I'll get income tax expense. If they give me income taxes payable, I just need to divide that by 30% to get back up to taxable income. You just give me a couple boxes and I can fill in the others. Now, a lot of times they'll give you pre-tax financial income or taxable income, but they won't give you both. And so what you have to do is convert it. All right, and that's what we're doing in this example. Okay, so we're going to convert it. And the way we're going to convert it is to say, okay, US GAAP versus Internal Revenue Code, what are going to be the differences? Well, we're going to assume everything's the same except any details they tell us. And here, this credit sale is going to be a temporary difference. So under US GAAP, I have pre-tax income of $300K, but from the IRS perspective, $180,000 of revenue here is not revenue. So my IRS income is really 120. I gotta take out those accrued sales. Okay, so if I go back to my boxes here, you think about it, they say, okay, 300K. I just converted. This one is 120. So boom, I got the answers now. I can just times them by 30% each. And that'll give me income taxes payable and income tax expense. I got my answers. It's that easy. So income taxes payable, the 120 taxable income times 30% equals $36,000. So then what is the journal entry to record income tax expense and income taxes payable? Well, here's how it's going to go, guys. My income tax expense is based on the GAAP income times the tax rate. My income taxes payable is based on the IRS taxable income times the tax rate. So they're not going to be the same. The difference between the two goes in what we call a DTL, a deferred tax liability of $54,000. Now, why is it a liability? Well, think about it. You're getting your revenue now, and you're not paying any taxes on it. So in the future, as you're going to be collecting that money, the next $180,000 of credit sales you collect, you're going to have to pay taxes on that. So you kind of have that, the future, you're going to have to be paying that. Okay, let's continue the example. I just copied some of the details here in case you didn't write them down. Part C, they say prepare income tax expense section of the income statement for 2014. Well, here's what it would look like. You'd have your pre-tax financial income of $300,000. Income tax expense, you're going to have current is 36, deferred is 54 for a total of 90,000. So the income tax expense is 90,000, but we also alert financial statement users to the fact that some of it is deferred. Okay? I think that's good for this video. Yeah, that'll be good.